All right, everybody, welcome back to the Rice Report. Today, we are joined by David Bahnsen. This is going to be an absolutely fantastic conversation. Very short and to the point. As you can tell, he is in a suit. He is in New York City. He has appointments and things like that. We're very gracious to have you here for a few minutes to talk a little bit about the economy. David is an author, and he's put together pretty good collaboration of books in different various aspects. The crisis of responsibility, a cultural addiction to blame, and how you can cure it. I love that topic, by the way. A case for dividend growth, amen. And there's no free lunch, 250 economic truths. And last year he came out with Full-Time Work and the Meaning of Life. So David, thank you for writing these books. I think we need more very good ideas out there from a broad spectrum. But give us a little background on you and kind of what you're seeing in the market right now. Just want to give you the forum and explain what you're seeing in the environment. And then we'll have a discussion about what the economies look like here and abroad, because things are really kind of shaken about, and I'd love to get your perspective.
Well, I appreciate it. Thanks for having me. I will say that I think the idea of markets and the economy shaken up and a lot of ambiguity and uncertainty, I think that's a permanent condition of markets. There are very few periods where there's perfect clarity in the economy, especially on a global level. Sometimes you're in a period of pretty structural improvement in a domestic economy. Other times you're in a period of very structural contraction. But for the most part, it's usually a mixed bag. And we've had a mixed bag economy for some time. I think we have such now. And I think the mixed bag is not just in the short term that there is a mixed bag of good and bad things now, but it's mixed in the difference between short and long term. In other words, there's certain green shoots I see that are positive right now or could end up being positive 2025, but there are other things that linger longer term, almost always related to excessive government indebtedness. That even when you talk about short and midterm positivity in an economy, as long as looming over such an economic environment is $36 trillion in national debt or 7%, budget deficit to GDP ratios, 25%, much higher in countries like Japan and certain European nations, 25% debt to GDP. Those things are really major issues longer term, but short term mixed bag. That's our assessment.
Yeah, so we're watching, kind of this volatility era right now with trade wars pending, and we've talked about tariffs here. You've talked about tariffs. If the country doesn't know how tariffs work by now, after a month of every economist in the world explaining them, I think we're going to pass that. Let's get into the foregone conclusion that tariffs are here. Tariffs are going to strengthen on April 2nd. And trade war, what does that mean for market volatility? We're seeing sell off pretty rampantly and then buy up on the dip and then sell off at the end of the market. Is this a trader's market or a buyer's market?
Well, it's depending on the investor. I don't think that those who try to trade in and out around the headlines, around the tariffs, around the data are going to have a lot of success. But I also do believe that an index investor right now is owning something and buying something very different than it's historically been. There's a sort of implied diversification benefit of owning the S&P 500. You're getting 500 of the world's greatest companies. But because it is weighted by market capitalization and the concentration at the top has moved in a way that is unprecedented in history, we went much of my career with there being no companies that were 3% or more of the S&P, or maybe a grand total of any company that was 3% or more equaling 5, 6, up to 10%. It's over 30% of the S&P now. The Mag 7 got close to 40%. We entered the year with 10 companies being 40% of the S&P and 490 companies being the other just over half. So that market approach of just buying the whole market has really become very levered to a few multi-trillion-dollar companies. And yet trading around it, I don't know very many people are really all that good at doing so. And so, the timeline and perspective of an investor, we happen to have a very strong philosophical belief in growing cash flow companies that are evidencing their own value orientation, their own quality, their own sustainability of earnings, their own lower volatility through the growth of their own dividend. And so as dividend growth investors, we feel reasonably insulated from some of the things that could happen in markets. I think it's a very evergreen strategy. It's not just this will work this year and let's do something different next year. But, if people think Nvidia at 50 times earnings is going to 70 times, or Apple at 40 times is going to 50 times, or the S&P at 23 times is going to 26 times, all just unprecedented valuations, then they may end up doing very well. But the 2009 to 2021 bull market was unbelievable. 22, things dropped a lot. 23, 24 came back up. 25, they're now showing a little more signs of vulnerability. I think we're in a choppy market potentially for years to come. That speaks well for value and dividend growth, not so well for large cap growth.
Yeah, I completely agree with that. I mean, the dividend strategy is completely evergreen. Even my grandfather, who was not a rich man, he said, "Don't buy anything that don't pay you." Right? Like I still remember that. And in this market right now, of course, debt is a major issue. It's not just us. What is the global GDP or debt to GDP ratio around the world is well over 200%. What does the bond market look like moving forward? The Magnificent Seven, that overall, I've been saying for a long time that the market is a medicine ball balancing on top of a baseball bat. It's just really top heavy. And what does the bond market look like? And what are they going to do about the 5 and 10 year strategies moving out to get those interest rates down?
Well, they don't have a lot they can do when you start talking about 5 and 10 years. And this is one of the things I wish people would understand, that the central banks of the world can and do a lot to control the short end of the curve. When you start talking about 5 and 10 years, I really am pretty old school on this, that the 10-year is more or less the best. The 10-year treasury is more or less the best encapsulation of nominal GDP expectations, the combination of inflation and real growth. And when you see a bond yield coming down for good reasons, that could mean one thing: less inflation, more growth. But when you see it going up for good reasons, that can be a good thing. Not so much inflation expectations, but more real growth. But when you see it going up because of higher inflation but less real growth, that's not. So it's complicated because people want to look at bond yields to get a signal for what's happening in the economy and the market. And, everybody from 2009 to 2021 celebrated low interest rates, short end of the curve and long end of the curve. But I will tell you, the reason bond yields on a secular structural level came down was because of embedded lower growth expectations. That's not good.
No, that's not good.
And so I don't think inflation will be higher than 2 to 3%. And I could see an argument, what we saw out in Japan, that it ends up going lower. But if that's accompanied by lower nominal GDP expectations because of lower growth, I think that we have to just get used to this new paradigm. Getting back to 3.1% real growth that we had from World War II to the financial crisis, we're not even close to getting there. And at $36 trillion in national debt, I don't know how we're going to.
Yeah, I mean, we're actually on the other end of 3.1%. The Atlanta Fed for GDP now just reduced their expectations for Q1 GDP from 2.3 down to negative 2.4.
Right.
This indicator for people not used to economics, and I kind of do the intro level stuff, the explanation. This is a projection. It's not the actual Q1 GDP. It's their anticipation. Why is that number almost 5% upside down?
Well, here's the thing. I am one who really does believe in the GDP calculation, that there's a couple ingredients that are more important than others in terms of the sustainability. So when you get a GDP number, plus or minus, it's reflecting how it did versus the quarter before. And the Atlanta Fed's number right now that went from positive to negative is based on a pretty dramatic recalculation of expectations on imports and exports. As a lot of people are trying to get in front of tariffs, there's been a big adjustment on the tariff number, which pushes it negative. But then the next quarter, if that isn't sustained, then all of a sudden it can come back the other way. So it's not necessarily a recessionary indicator, but the problem, like when you went all through 8 years of the Obama presidency, the number that never got up, why we had about 1.6% real GDP growth. We had no recession. It stayed barely positive. but you didn't get the normal bounce back. You get out of recessions. And the reason was business investment never came back. Capital expenditures, what they call in the GDP formula, non-residential fixed investment. So everyone's always obsessed with the consumer. The consumer's activity is generally pretty repeatable quarter after quarter, but our consumer doesn't stop spending in America unless they run out of credit. So we have credit recessions where the consumer slows down, but the consumer doesn't just wake up and say, I want to be more responsible this quarter. They just don't do it. What happens is we produce less, and that becomes problematic. And I'm not sure the Atlanta Fed number for this quarter is showing that. I think it's more likely a one-time adjustment. However, it doesn't mean that the data going forward looks great either. Even if you have positive numbers, there are, I know we're not going to talk a ton about tariffs, but if companies are adjusting inventory and changing their plans based on higher taxation on imports, that could very well become recessionary.
And we have a consumer trend that's not good, right? We've had relatively high inflation for the past few years, and consumer credit is monstrous right now. Household debt is over 20 trillion. We've got credit card debt now approaching, I think, $1.7 trillion. So we do have the U.S. consumer in issues, and I think it was Barron's 2 days ago that came out and said that currently, right now, the top 10% of earners are spending 45% of consumer capital in the marketplace. What are the trends you see moving forward with that?
I think it's really important to, there's so many data points I'm really bearish about, negative about. The consumer side and the household side. The other data point is that household debt to assets is the lowest it's ever been, or been in a long, long, long time. So debt to income is the lowest it's been in a long, long time. So you have a numerator and a denominator in every fraction, and the credit card debt is higher than it's been, but it's higher divided by a far higher level of assets and income. The issue to me is the delta between the top earners, the lower earners. Bottom 10% of wage earners are certainly in a very precarious position, but I don't think it's from credit card debt. I think it's from housing prices. So that's the real elephant in the room. Is shelter is now taking up 50% of disposable income for lower income people. For higher wage earners, it could be 8% of income. It could be 10% of income, even though they have expensive homes, but their wages are so high. That's a great thing for them. But it's really hard with macroeconomic data when it paints such a different picture for certain quartiles of income earners. I think that the inflationary pressures in shelter are what I'd be focused on. Goods prices deflated year over year in 2024. Where people are feeling it is, we talk all the time about eggs, which is a more bespoke thing, but shelter, rent, you need to create more housing. It's a supply issue. It's not demand. And so until they can get more supply of housing, I think we have that ongoing issue. It's taken up too much wallet share for middle class and low income wage earners. I grew up, before I had a lot of money. I thought when I was starting off in my life, we were supposed to spend about 28% of our income on shelter. Now people are spending almost double that. I don't know how they have any money to go out to the restaurants on Friday night. You know what I mean?
Oh yeah, we love to overspend, right? That's kind of the American model for the last 30 years. Is if you don't have the cash, use the credit, and if you have the credit rating, buy a big house. And you're right, 50%, 52% of all household income is going towards housing right now. But we also have this problem in the housing market where I think the latest stat was 60% of all American mortgages are under 5%. No one's moving those markets right now at 6.5%, 7% in mortgages. Yep. So I think that these are short-term blips. I don't see them as being, there's a lot of doom and gloomers that'll say, oh, this is the end of the market. It's just not how markets work. They're cyclical. They continually evolve. You're always going to have bullish and bearish information in sectors. And I want to focus on the bullish side because most of the economy right now, and I'm a victim of this too. It's easy to get hung up in bearish numbers because they're literally everywhere. What areas of the market are you bullish in right now?
Well, we're very bullish in midstream energy, which is the kind of oil and gas story about the need for more pipelines, more terminals, more storage, more infrastructure. And I think that that's a great secular thesis. Ironically, it did extremely well in the Biden administration. But that was largely because he was artificially constraining supply of new pipelines, which made incumbent pipelines worth even more. And then I think the growth opportunity in the Trump administration is that they're going to allow more pipelines to be built, more permits, and then that just leads to more growth as companies are able to expand volumes more. Not to mention the liquefied natural gas to build terminals that can export more globally. So there's a
Very
midstream
bullish. Yeah.
energy infrastructure story we like a lot. Look, from an investment standpoint, there's no evidence to me right now that what we're looking at is a significant bear market, which is largely driven by valuation bubbles bursting, which so I think that can happen, or a recession. What you're seeing is a rotation where a lot of the healthcare names, consumer staple names, real estate names that were more defensive are doing very well. And then the things that had been doing well, that were way overpriced and overvalued in technology and communications and consumer discretionary, they're coming down. I talk about this all the time. It's the story of 2000 that a lot of people missed. NASDAQ dropped 50%, ended up being down 70% and stayed down for 15, 16 years. The Dow was up in 2000 and up double digits and was still up until 9/11. And so we had a 30-month bear market, but value, large cap, Dow type names, they were doing just fine. And so I think we might be in just a rotation that goes from very cyclical and very technology oriented names to less economically sensitive, more durable names, more defensive. And, utilities have historically been a big part of that, but that's different now too, because a lot of utilities had a big run up in expectation of higher power needs for AI CapEx. And if that story unwinds, you may have a thing in a barbell where the riskiest thing in your portfolio drops and the safest thing in your portfolio drops, but consumer staples are historically a pretty good place to be in an environment like this.
I couldn't agree more on natural gas infrastructure. I think we're watching the bifurcation of oil and gas right now, the way the oil is not plummeting. Everyone loves to use hyperbole. It's down like $10 a barrel, but it's dropping while you're watching natural gas hit 2-3-year highs. And I think that natural gas run is going to continue with the onslaught of AI, which requires an intense amount of energy. So I think that that's a great place to go. What are your views on the AI space right now? What players are you looking at? Obviously, Nvidia takes the cake, but there's 250 players in the market right now.
Well, and our view is that the lessons we learned in the 1990s are going to dominate this story again. All the money made so far in AI for investors is public companies that they're kind of in the kitchen of AI, not the dining room of AI. In other words, they're making the stuff that makes AI.
Yeah.
Ultimately, this AI thing is going to die a painful death if somebody doesn't figure out how to use it to make money. If all you're doing is building it, and so you're making the chips that make the product possible, but the product doesn't lead to. So that's what happened with the internet. Is all the Cisco's and Juniper networks and everything were the big winners in the 90s, and then eventually all those .coms crashed. But then out of it, you found out, well, the whole economy. The whole Fortune 500 will utilize the internet to drive a better product, to drive a better process, to gain more efficiency, productivity. So those who made the internet weren't the winners of the internet. The people who used the internet were the winners. If that doesn't happen with AI, this is going to be one of the biggest money-losing ventures in human history. There's hundreds of billions of dollars of capital expenditures being spent right now, where the hyperscalers spending it don't really know why they're spending it. They're reasonably optimistic, probably for good reason, that there will end up being an evidenced utility, but that has not been apparent to me yet. So for us, I think the story of how the kind of back end companies, your Nvidias and all the others, how they've benefited so far has been very apparent. Hyperscalers are giving them purchase orders that are ungodly in their size. That can't go on forever. The margins come in, global competition comes in, whether it's DeepSeek or something else. There's just a lot of downward pressure that will come on margins and purchase orders. So we're not big bulls on that side of the story, but I'm not saying AI is all a fake. I think the issue is who's going to really utilize it to drive more efficiency in their business. Nobody's really talking about that. No one's looking at how AI is going to be a business utility like the internet was, or the cloud, or even, go back far enough, just mainframe computers.
All lost leaders. All lost leaders in the marketplace. That's an interesting take, because it's almost like they're building the picks and shovels without an actual gold rush, right? Like that's kind of where we are in that space right now. Very good point, David.
Yeah.
That's huge. So we got a few minutes left here. What about the gold market? What are you seeing in that area? That's obviously a topic everyone's covering right now. I've covered it 3 times. What are you seeing in that space?
Yeah, we had been gold investors for a period of time. We haven't been for a while. That's a longer term reason. I have no doubt it's been a very good trade lately. My fundamental thesis, after studying it for almost 30 years and monitoring it for, I've studied 50 years of gold, which goes back my whole life, but I've studied it for, 25 to 30 years professionally. And my belief is gold goes up when central banks are buying and gold goes down when they're not.
That's right.
And people that think it's an inflation hedge, or they think it's a hedge against reckless activity of fiscal policy or monetary policy, nobody can come up with a worse decade than 2011, 12 to 2021 for quantitative easing, for money supply, for artificially low rates, for negative interest rates, for all sorts of aggressive interventions from central banks, while countries from Europe to UK to US to Japan were blowing out their debt levels, and gold didn't go up $1 in 10 years. And now it's moved quite a bit here last couple of years, but inflation adjusted, it still has a negative return for 50 years, for 40, let's call it 45 years since 1980. That's incredible to me. And so I don't see it as a long-term inflation hedge, for the obvious reason that it hasn't been a long-term inflation hedge. But there's periods where it's a dynamic trade, and that's a little outside of what we do. So we're not gold owners now. But if we were to be, we'd probably want to play it with miners and operating companies, not just speculating on the underlying commodity, which is just really very levered to what central banks are doing.
Yeah, and their buying run, it looks like it's coming to a halt or a slowdown right now. So the last 3 years they've been accumulating like crazy, foreign central banks. I'm with you. I was huge in gold in 2021. I don't think I've bought any in the last year. But at the same time, I do love gold. I think it's a great way to not lose money. That's kind of the 10-year decade. You saw that. Now we've seen 100% run up since 2023, which is fantastic for gold owners. But diversification is huge, and I think people are scared of the stock market. I think there's half of the country is terrified of the stock market. I think half of the country can't wait to get more money in, as evidenced by 54% of allocated assets for the average household are now in the stock market itself. What's your view on the next year there?
Keep in mind, of that 50% that can't wait to get more money in the market, there's a percentage of them, and it's not 100%, but it's a high number, that have never lost money in the market.
Yeah.
They put money in for the first time a few years ago, and they don't know that Nvidia can go down and stay down and be down for years. They've seen a couple little downward spikes that lasted a few minutes. The COVID crash in 2020, which a lot of these people weren't even investors till later. But even if that you lived through that, the market dropped 36% in 31 days.
Yeah.
And was up, the next month and every month thereafter, the rest of the year, basically. So it's the 2002 bear market. It's the 2007 to 2009 bear market. Now, those were extraordinary circumstances. They're not normative. Those types of drawdowns of 40 to 50%, they really require a pretty significant recession or a valuation bubble that bursts. I'm not predicting anything like that, but I do think that what I'm predicting through, which is just sort of an up-down type choppy market, and you wake up in 5 to 8 years and your S&P's compounded at 3 or 4%, that's not the risk level people are taking on to get those kind of returns. That's not their expectations. So that's why the dividend growth thing is so important to me. If you get companies that are growing their dividend at 6 to 9% per year, and along the way, I'm accumulating, not spending the money, I'm gonna really benefit from that volatility. Yeah. As I'm reinvesting dividends at lower prices along the way, and up and down movements. And then if I'm a withdrawer of capital, I'm in a distribution phase of life, and I'm just getting a 6 to 9% increase in my dividend every year, I don't really care what underlying prices are doing.
Yeah.
I'm immunized, I'm defensive. But if you're trying to withdraw from the S&P 500 for a 2 to 3 year period when it's going down, you were going to light capital on fire.
Yeah, I agree. The dividend model has always filled the difference between the peak and the valley. That's super important. It's one thing I don't talk about on the podcast is the dividend structures right now. There are companies bolstering dividends right now to be attractive in a choppy market. And I think that's a very important place to look.
Yeah, and there's plenty more that could be doing so. You have a pretty low payout ratio and a lot of low participation because so many companies didn't have to pay a dividend for so long. So the S&P, everyone says for 100 years, it's averaged 10%. That's true. But for most of those years, it was doing it with about 5 or 6% growth and 4 or 5% dividend. Now the dividend's 1%. So if you think it's going to get 9% price growth forever after the last 15 years of getting 16% price growth, starting at a market multiple at 23 times earnings, I'm sorry. That's a very optimistic outlook. I think rotation is needed. I wouldn't get out of public equity, but I'd be more conviction. I'd be more selective. That's the way I'd put it.
I think that's one of the reasons you're attracted to the midstream market. Is very dividend heavy. A lot of MLPs in there, a lot of monthly distributions, a lot of things that can actually fill the gap between the peak and the valley. So important to do. Reduce your own personal liability in the marketplace and gain those monthly income and reinvest. Like that's kind of the beauty of dividends.
That's right. And you're de-risking every 3 months. Every 3 months, you have monetized a little bit of the risk you took. Where companies that don't pay the dividend, every 3 months, you're compounding your risk. That all works out great when you buy Microsoft in 1987 or Apple in 2009. Those are world famous historical stories, but there's no precedent in human history for the leaders of one decade being the leaders of the next decade. A dynamic market economy doesn't work that way. And so I have nothing bad to say about Nvidia or Apple. These are some of the biggest success stories ever. But the math is the math. They're $3 trillion companies. To go up a whopping 10%, which is a regular market return, just to get 10%, you have to add $300 billion of value, which is more than like tons of companies put together, their entire value, just to get 10%. Whereas previously, everyone's talking about what it did the last decade. You were starting off at a position of a much smaller valuation. So I just think the bias we have to what just got done doing well and assuming it plays forward, I don't think there's a lot of historical precedent for that. That's why I'm recommending a different approach.
I completely agree. And I think Nvidia won't say anything bad. They're a great company, but they're due for a correction. I think that's an obvious play in the market. So, David, this has been fantastic. We've hit our time here. I know you've got a meeting, and I really appreciate this insight. This is valuable information for our listeners. How can they reach out to you and find you online?
Dividendcafe.com is where I do a weekly market commentary every Friday where I'm talking about some investment theme. It's all free, dividendcafe.com, and they can subscribe there if they want, or just check it out and see if they like what they see. And then from there, they can look at our company website and other things if they want more information. There's podcast, video, all of it. But dividendcafe.com is kind of the hub I'd recommend they go to. And again, it's, the only thing I want to say is there's a lot of things online. We manage over $7 billion at our firm every day. We're managing real money, and we could be bad at it. We could be good at it. But there's a lot of people right now sharing a lot of information that don't manage any money.
Yeah.
And I think skin in the game is an important part of investment management and economic commentary, something for people to think about.
I couldn't agree more. Online is it's a crapshoot, man. It's a crapshoot. David, thank you so much. This has been fantastic. Everyone check out the website. Go see him on Friday. That's tomorrow. So hop out there, or it might be today when this comes out. But thank you so much, David. I really appreciate it. I'd love to have you back on in a few months here and get a catch up on the market and get some commentary.
Look forward to it. Thanks so much.
Thank you, sir. Appreciate it.